This video is about a pretty much undiscovered IPO from June 2021 called iSpecimen with a market cap of about $45 million at the time of recording, which may be one of the reasons why this company is so little covered by analysts. If you share my investing strategy, which is about investing in small, undiscovered companies with a potential high growth runway, you should definitely not miss this one. The shares of iSpecimen started trading at the Nasdaq Capital Markets under the symbol ISPC at a price of about $7.50 a share. The IPO intended to raise $18 million in capital, which will be used to expand the platform offerings, business development, and fund current operations for the next 24 months following the offering. But now let's talk about the company's business. And this is pretty amazing. iSpecimen was founded back in 2009 to address one critical challenge: to empower researchers to instantly search for and gain access to patients' biospecimens and data across a global network of healthcare providers. iSpecimen considers itself as a marketplace for specimen procurement. Hold on. What the hell are specimen? All you need to know is that specimens are samples such as human biofluids, tissues, and living cells which are taken by healthcare providers during clinical care. And for researchers, those specimens are particularly interesting for drug discovery and development. Well, if you hear about marketplaces, you immediately think about the Amazons, eBays, or Etsy's of this world. And this is what makes it interesting, right? Because, as we all know, marketplaces can be highly attractive for investors if they scale efficiently. So, let's think a little bit about the problem this company is trying to solve. Due to the high fragmentation of the market, it is very challenging and frustrating for researchers to acquire specimens for their studies. There are over 10 million healthcare providers out there which can provide specimens. Well, in theory, a lot of specimen are never used because researchers would need to contact a large number of healthcare providers by making phone calls, sending emails, or spreadsheets with required specifications back and forth. And the story does not end here. Each healthcare provider may have different procurement processes and compliance regulations concerning patient data, making the fulfillment experience a time-consuming exercise. Okay, I think we can say that this is a real nightmare. And for the last 10 years, not much has changed here. As you can imagine, it can take quite some time and effort to bring all of these diverse healthcare providers on one common platform. Think about patient and specimen records residing in legacy databases at healthcare providers in various formats. In order to achieve their vision of providing a unified platform for researchers and specimen providers, a lot of technical groundwork had to be done. According to iSpecimen, more than 80 staff years have been invested so far to bring the platform on today's level. Interestingly, the platform does not yet support full self-service, meaning orders require still assistance by iSpecimen staff. However, they are working on it, and fully automating the fulfillment process could be a meaningful catalyst for revenues and also the operating efficiency. By looking at some numbers, one can see that it is pretty impressive what the company has achieved so far. This graphic shows their progress in onboarding provider organizations on the platform. Number of suppliers has grown from about 1 to more than 180 as of June 2021. And the number of specimen and patient records has grown even more, from 0 to more than 66 million and 12 million respectively. And with the expansion of the provider network, the number of research customers has also grown. So this is how a marketplace should work, right? The product catalog of iSpecimen comprises search, procurement workflows, compliance management, and, as one can imagine, big data. By integrating all the stuff we talked about earlier, by looking at the platform capabilities, there is no direct competitor on the market. Could this company be a potential monopoly? Well, there are indirect competitors such as healthcare providers or labs who may offer access to specimens directly to customers. We produce specimens, so we sell them on our own. Commercial biobanks who purchase and maintain inventories of specimens. Retail business goes back to the 15th century, so why change it? This is ridiculous. Specimen brokers who act as a middleman between healthcare providers and researchers on a transaction by transaction basis. My father is a real estate agent. My wife is an insurance agent, and I am an agent in the specimens business. I don't care what you think about that. However, in reality, the market is incredibly fragmented, with most competitors having less than 1% market share, while no single competitor has more than 10% market share. Further, these are all indirect competitors, with none operating as a pure technology player like iSpecimen. And concerning the competition on provider side, owning physical inventory is an expensive business and nothing we would be interested in. Right. Last but not least, iSpecimen has the big first mover advantage on their side. Think about the effort it would take to copy their platform. Due to the data-heavy nature of this job, it would not be feasible to copy it straight away. So what about the growth runway? Well, the target available market is estimated to be around $3 and $4 billion, growing at a 10 to 15% compounded annual growth rate. In a recent interview, I will link the interview below, the CEO Christopher Iannelli made the statement that they target around 10% of the market within the next 5 years. So this would come in at around $300 to $600 million in terms of market size. Well, so what? Okay, let's break this down further. If we assume that the market size equals the value of specimen being traded in a given year, or the so-called gross merchandise value, and iSpecimen's take rate is at around 15%, which is similar to other marketplace models, a captured market share of $300 to $600 million would translate into yearly revenues of about $45 to $90 million, which means 5 to 10x their revenues in 2025. Interestingly, the company outlines in their S1 filing that currently they do not charge any fees for their software. Remember that subscription fees are highly valued by investors because of their recurring nature. Part of their growth strategy is to work on recurring revenue streams such as premium search subscriptions, patient data subscriptions, patient recruitment for clinical trials, and software licensing. As you can see, there is some promising optionality in the longer term. Catalyst can have a big impact on stock price performance once released. Talking about customers, one thing to consider is that recently only a few customers represent a significant proportion of revenues, like 15% or sometimes even about 30% in fiscal years 2020 and 2021. If one of these customers resigns, the revenue would be significantly impacted. Further, due to the nature of their clients, the company books high receivables compared to their revenues. This could impact their cash flow and working capital. However, do not forget that this is a fairly young company with a market cap in the millions. The current concentration risk could be meaningfully mitigated by just scaling operations further in the near future. One nice fact about customers: several U.S. government agencies belong to their customers, among them the Centers for Disease Control and Prevention. And guess what their demand is in times of COVID? A few sentences about COVID. Despite COVID partially disabling their worldwide specimen supply, the company's operations were rock solid. This is because the order volume of COVID-19 specimens have offset the supply limitations significantly. About 30% of their purchase orders in the first 9 months of 2020 accounted for COVID-19 specimens. Once the supply is ramped up back to pre-COVID levels, the COVID-19 specimen could represent an additional revenue opportunity. The company employed a mobile service provider which is able to collect specimens from research subjects in their homes. Christopher Iannelli, who is a PhD in his subject, has been CEO of the company since founding iSpecimen in July 2009. Before that, he served as a managing director at a life science investment bank and co-founded a healthcare investment research firm. It is very positive to see him on board for a long time. Further, the entire management team seems to be well incentivized. Most of them have a compensation package split more or less equally between base salary and option awards for achieving performance KPIs. Insider ownership for the CEO stands at about 5%. Total ownership of insiders is about 56%. Institutions own 16%. The remaining shares are held by retail investors. As you know, skin in the game and a well-incentivized, competent management team is always a positive sign and shows a high degree of commitment also for shareholders. Lastly, let us look at the financials for valuation purposes. As you can see, as to date the company has already a quite promising gross margin of about 50% plus. For a software company, the gross margin is at the lower end. But remember that the platform does not yet support full self-service. The company is still in hyper-growth mode and is expanding internationally. Revenue growth from 6-month ended June 2021 has been 80% up from the same period a year ago. This graphic shows their progress across several KPIs over the last years. Remarkable is the fact that revenue growth stalled between mid-2018 and mid-2019 because of software issues which are considered as resolved now. Further, the sales team was scaled from 1 person to about 7 people in 2019. So sales growth was basically limited just by the outreach of the company. The company has an accumulated deficit of about $27 million, but the IPO increased its net cash to about $13 million, which will certainly suffice for at least 12 months. As a consequence, there is no immediate liquidity concern. However, should the company not turn profitable soon, the company will likely need to raise more capital. At the time of recording, the company trades at an enterprise value of 3.3 times sales. I consider this valuation as a good risk-reward situation considering the solid growth, gross margins, business model, and opportunity. However, for more risk-averse investors, it might make sense to put this ticker on their watch list and wait until the lockup period has ended. This should be around mid-December of this year. Further, it might make sense to wait a few quarters more when the company has traded for a longer time on the public market and investors have more data on the progress of the cash flow profile of this company over time. Remember what Peter Lynch, one of my top favorite investors, said about timing. You could have bought Walmart 10 years after they went public and could still make 35 times your money. Hit the like button now and please subscribe to my channel if you like it.